1 year ago, I set up one investment, hit go, and then basically just let it run. £1 a day, every single day, automatically into one ETF, and I've never touched it since. And today, exactly 1 year later, I'm going to show you the real numbers, how much I invested, what it's worth now, and what my actual returns look like a full year after investing the right way. And then I'm going to run the maths, because based on the return I've gotten over this last year, I want to find out whether this investment is still on track to reach £1 million, and if so, by when. Now, the last time I did these calculations, the number that came back was just 15 years. Today, with a full year of real data, it's a different number, and I'll be honest, I wasn't quite expecting it. So, let's get started. Now, as always, I'm not a financial advisor, and everything in this video is for information and entertainment purposes. I'm sharing my own real experiences and my own numbers. Please do your own research and speak to a financial professional before making any investment decisions. So, for anyone who's new here, let me give you the 30-second version of what this is. About a year ago, I decided to run an experiment. I sat down and wrote out the 4 big investment rules that everyone talks about. And I thought, what if you actually just did all of it? No shortcuts, no speculation, no noise. Just follow the rules properly with the most sensible investment and see what actually happens. And those rules came down to 4 things. Number 1, diversify. Don't put all your eggs in one basket, spread across companies, sectors, and regions of the world. Number 2, invest for the long term. Buffett's own words, if you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. Number 3, pound cost average. That means investing consistently at regular intervals, no matter what the market is doing. Buy through the highs, buy through the lows, and your average purchase price evens itself out over the long term, taking the risk out of timing the market. And number 4, reinvest your dividends. Don't take the income out, feed it straight back in, let compounding do its thing, and give your investment the best possible chance to grow over decades. 4 rules, simple. But I needed one investment that could do all 4 at the same time. And after doing a lot of research, I landed on the Vanguard FTSE All-World ETF accumulating, ticker symbol VWRP, listed right here on the London Stock Exchange. And here's why this ticked every single box. Diversification. This ETF holds over 3,600 of the world's biggest companies across 11 different sectors: technology, financials, consumer discretionary, industrials, healthcare, energy, you name it. You are not betting on one company or one sector or one part of the world. You are spread across thousands of them. The top holdings are the companies you recognize: Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, Broadcom, the biggest, most established companies on the planet. And then geography. The USA makes up around 62% of the fund. Now, of course, that's also where the world's biggest companies are listed. But you also get Japan at around 6%, the UK around 4%, China, France, Canada, and more on top of that. This gives you genuine global exposure to the best companies worldwide. And it's an accumulating fund, which takes care of Rule 4 automatically. Dividends don't get paid out, they're automatically reinvested back into the ETF. The expense ratio is low at 0.19%, and the fund manages over £23 billion in assets, so it's one of the most widely held ETFs in the world. Now let's get to the performance and how this investment has worked out for me in the last 12 months. Over the last year, this fund has returned 22%. Over the last 3 years, this averaged 20% per year, and over 5 years, 11% per year. Now, we'll unpack what those numbers mean for my £1 million target in just a second. But if you're finding this genuinely useful or interesting, please hit the like button. It takes 2 seconds and it genuinely helps more people find this video. Okay, so 1 year, 365 days, £1 invested every single day automatically through my Trading 2 and 2 Pi, which I set up once and have not touched since. Here are the real numbers. The total amount I've put in is £365. The current value is £415. The total profit is £51.37, and the return is 14.12% in 1 year from £1 a day, which basically anyone can do. Now let's pause for a second. 14% is a strong return by pretty much any measure. The average savings account right now is not even close. Most cash ISAs, not even the same postcode. A global ETF, following every rule of responsible long-term investing, returned 14.12% on actual invested money in 12 months. Now, some of you will have questioned the performance figures from earlier, right? The fund returned 22% over the last year, so why did I only get 14% if the fund did 22%? And that's a really important point, and the answer is pound cost averaging. Because I didn't put in £365 on day one, I drip fed £1 in every day throughout the year. So the £1 I put in on day one has been in the market for a full 12 months and has seen the full year's growth. But the £1 I put in on day 200 has only been in the market for about 5 months, and so on. So on average, each pound I've invested has been in the market for roughly half the year. That's why my return comes in lower than the fund's annual figure. It's the trade-off for spreading out the risk. So my average purchase price is £123. VWRP is currently trading at £141. So now we get to the important bit. Because in my month 5 video update, I used AI to run the calculations based on my returns at that point, which were strong returns early on of 10% in just 5 months. And the projection came back at 15.3 years to reach £1 million. And I was honest at the time, those were unusually high returns, boosted by a particularly strong period in the market, and I said that number was almost certainly too optimistic for the long term. So now we've got a full 12 months of real data. Let's run the proper calculations and give you the real scenarios. So starting now at £415, investing £1 a day for the target of £1 million, here are the different scenarios. Scenario 1, the conservative case. This uses the fund's 5-year average return of 11.18%. And to be clear, this is the figure I find most useful for long-term planning because it covers multiple market conditions over 5 years, not just the recent bull run we've had. So if the fund continues to average 11.18% per year going forward, the math says it would take approximately 53 years to reach £1 million. That would put me at around 87 years old. So yes, that's technically within a lifetime, but that's probably not the plan I had in mind. Now, scenario 2. This one uses my actual return, the 14.12% I personally made over the last 12 months, and if that annual return continues, the calculation gives approximately 44 years to reach £1 million. That puts me at around 78 years old. Still within my lifetime, still not before retirement, but £1 million at 78, I'll take that over nothing. Now scenario 3, and this is where it gets really interesting. If the fund continues to return what it actually returned over the last year, 22.56%, then the math says I reach £1 million in 30 years. That puts me at around 64 or 65 years old, which for anyone keeping track is right around retirement age in the UK. And by the way, if I use the 3-year return of 20.57%, I get a similar result, about 33 years or age 67, again, right at retirement. So depending on which scenario plays out, I'm looking at somewhere between 30 and 53 years to reach £1 million. Now, the reality of long-term investing is that nobody can tell you which one of those is going to happen. What I can tell you is that under every one of those scenarios, this investment, started from scratch with just £1 a day, has a realistic path to 7 figures. Some of those paths get there by retirement, and of course all of them get there within a potential lifetime. And by the power of compounding, if I live to 100 like Sir David Attenborough, then these are the potential returns from £4 million up to £1.3 billion. And this is from £1 a day, invested automatically without me having to think about it. Now, let's be real for a second. I'm not going to sit here and tell you this is guaranteed. It's not, and it never will be. Markets go up and they go down. There are going to be years this fund loses money, and I fully expect that. But the 4 rules I set from the start: diversify, long-term, pound cost average, reinvest your dividends, those are designed specifically to absorb that volatility. When the market drops, my £1 buys more shares at a lower price. When it recovers, those extra shares are worth more. That's the whole point of the strategy. What I know after year 1 is this. I've invested £365. I've got £415 sitting in this account. That's £51 profit, 14% return. All from £1 a day, fully automated, growing while I sleep, while I'm at the beach, or paddleboarding on a lake. And under realistic scenarios, this has a genuine path to reaching £1 million. But even if it doesn't, I'm sure I'll be happy with me putting away the investment and the returns either way. So I'm going to keep up with this challenge. Whether the market goes up or down, the plan stays the same. So if you want to follow along as this progresses, along with the rest of my £16,000 portfolio across dividends, stocks, ETFs and more, please do subscribe. I'd really appreciate it. And if you have any questions on this or anything else finance related, drop them in the comments below, and I'll see you guys next Wednesday as always on Casual Cash. Cheers.